So let's dive straight in with some content that people might find useful. So I'm going to ask you a question, and maybe you can give me some answers to that. You know, I look after a company that does a lot of lettings and quite a lot of sales too. And when all the information started coming around that this situation, this coronavirus was coming to the UK, there was a lot of concern. The markets tended to slow down even pre-lockdown, then obviously since lockdown it slowed down. Then there was all these conversations that surveyors won't go and do valuations, and the mortgage world has come to a halt, and unless you've got a 50% or 40% deposit, you've no point in even applying for a mortgage. And in fact, if you did apply for a mortgage, there might not even be somebody at the bank or the lender able to process that mortgage, and the media tended to be jumping on that sort of message. But from what I understand, that's not really what's happened. The banks have been doing something else, and in fact,
yeah, I think, as I said, there's a lot of misinformation. And I was speaking to an economist a couple of days ago who was highlighting the point exactly that the media will always jump on worst case scenario straight away, because obviously that's what people want to sales papers and people want to hear, or they don't want to hear. That's what they end up hearing. So. But the misinformation that was going out there is that the mortgage market was in meltdown. Like most businesses, what's actually happened is we've all had to find a new normal. And the new normal is a new way of working, the redeployment of staff back to home working, changing systems, changing processes, managing people, because we're not robots, and obviously staff aren't robots. Obviously we're managing the expectations of their staff, learning to become school teachers at the same time as doing their jobs. So, and the banks are no different. They've had to deal with these situations as well. So on top of that, they've had to do with a hell of a lot of people asking for mortgage payment holidays. Now, quite rightly so, obviously they've had to deal with that, but one bank had over 250,000 requests. So any bank, at the same time as dealing with a redeployment of their staff, needing to deal with an increase in workload, has to make changes. So the biggest change that was made was that they had to, in a sense, almost halt new applications coming in. And an easy way of doing that is to take away products that are more risky or that would require more attention or more underwriting. So that's effectively what happened. They withdrew the products above 60% loan to value in order to use their resources, their current staff, to handle the calls for people needing to take payment holidays and answer questions around payment holidays. So that was the big sort of change there. Now, normally you'd say, well, why didn't they outsource it? Or what was their disaster recovery plan? Well, the disaster recovery plan was to shift resources over to their overseas offices. But some of those offices are over in India, and as we know, they're on full lockdown. So they didn't necessarily have a disaster recovery plan for a disaster recovery plan. Some say that they should have done, but my view is that they just needed to be given a break to a certain degree, in the sense that, well, you know, they are a business and they've been dealing with a hell of a lot, and I think they've managed it in the best way that they could have done, which was to reduce some products, create a bit of use their resources where they were needed most, and effectively, with the inability to transact loan to values above 60%, because they would tend to need a physical valuation, they did the right thing. You know, coupled with that, Rich, was obviously also the fact that they couldn't carry out physical valuations, or they couldn't assess the securities. And it's been really pleasing to see that there's been a huge uptake on using AVMs, automated valuation models, and desktop valuations. Now, desktop valuations are where actual surveyors are actually still assessing the valuations, but also using the automated valuation model in addition. So it gives them greater security. So I think, Rich, that's given them more. That's going to definitely be a way that they're going to continue to use going forward.
Great, Michael, and that's really positive to hear, because, you know, as an agent, I obviously follow a lot of the industry media, you know, and a lot of the industry media, unfortunately, were also putting out what I call attention-grabbing headlines at the time, and some of them still are, if the truth be said. But from what you're saying, it wasn't that banks were closing up shop, it's that they were redirecting their resources. The people that normally would be processing all those mortgage applications were now processing mortgage holidays. Therefore, because a lot of people, landlords and homeowners, have gone for these mortgage holidays, but that's easing up a little bit. So when do you anticipate those staff, having now been retrained in handling mortgage holidays, coming back and being available for normal mortgages? When do you anticipate them being available, and some sign of normal 10-20% normal homeowner mortgages coming back into the market?
Okay, so just to be clear, there are two types of lenders. You've got the sort of what they call high street lenders, which is your major banks, and then you've got sort of specialist lenders, which would lend in sort of the buy-to-let, specialist buy-to-let market, and potentially the credit impaired market. Now, the banks can come back a lot quicker because they've got the appetite to lend. They were just diverting their resources, and we send out a regular newsletter to a lot of the our industry contacts, and we were predicting that this week we would start to see a return to some of those higher loan-to-value products. And fortunately, as of yesterday, we saw 3 of the major banks nationwide, Halifax and Virgin, come back to the market with higher loan-to-value products, some at 75%, some at 85% loan-to-value. Some banks,
what are the rates like on those products? Are they similar to what they were 8-10 weeks ago? Have they changed significantly?
So there's rates available from 1.14%. So they're not changed significantly. Some lenders did increase slightly.
Yeah.
They've not reduced slightly, because they've not reduced as most people expected because of the Bank of England base rate change, because that wasn't really sort of built in at all. But no, the rates are sort of very competitive, and the lowest we've seen ever. So as low as that. But no, more specifically, just around the lenders coming back. So they've come back at sort of up to 85% loan to value. HSBC was still offering 95% loan to value, because they were assessing securities. They were still accepting the applications with the view that they were going to assess the security on a physical valuation at 95%. They're still accepting applications at 90% using desktop valuation. So, hats off to them. They haven't stopped at all. But so that's the high street market. Some of the specialist market lenders, because they're funded in a different way, they're not lending their own money. Effectively, they have halted accepting new applications with the view that they really want to assess the true impact of COVID-19 on the housing market and the property market before coming back to market. So you can understand that there is a market that we can't deal with at the moment, should I say. But we have been told that there's an appetite there. They just need more information. It's just similar
and that's more sort of adverse credit. Is it that type of market you're talking about, or not? Or are you talking more sort of limited company mortgages, or a bit of both?
Both. Limited company mortgages, adverse credit mortgages, lenders. I mean, the adverse credit mortgages have not gone away, which is good. Obviously, it's just limited loan to value. But even bridging commercial secured loans, that sort of market as well, as they are thinking, they are looking to assess the market conditions before being able to offer sort of maybe their more riskier products.
Which would happen in any sort of event that might impact any sort of even small events that would impact those type of things would happen. Now, that's not to diminish obviously what's going on, but that's standard sort of banking investment practice, I assume.